How's it going today, folks? Today I wanted to do an analysis, a comparison between a tried and true historical dividend ETF called SCHD, which is Schwab's dividend ETF, with a little more of a non-traditional ETF, a covered call strategy of QQQI. Now, some of you might say, can we compare these two? They're completely different strategies. One just holds underlying and yields the income against the underlying asset, and the other one is a covered call strategy. Yes, they are different, without a doubt, but they both have the objective of seeking income primarily for the investors. And so with that concept and that philosophy in mind, I think we can compare them in a sense, apples to apples, for its objective of what is best to generate income for you guys on a passive basis on a year, 2-year, 5-year, 10-year standpoint. So let's do a bit of a comparison and jump right into it. Okay, guys, so we're here at the Schwab U.S. Dividend Equity ETF Fund, their website, and just doing a quick summary. Well, what is SCHD all about? Well, the fund's goal is to track as closely the Dow Jones U.S. Dividend 100 Index. It's a straightforward, low-cost fund offering potential tax efficiency, but not really too much. The objective here is to serve as a core component to a diversified dividend income-focused portfolio. And then just doing a snapshot of its yields. So what we can do is see that its dividend yield annually is generally in between 3.5% to 4%, which is fairly good for a more traditional dividend style ETF. Its expense ratio is very favorable at 0.06%, so pretty much paying almost nothing for the management here, and it's not really that actively managed. Now, briefly looking at QQQI, and again, these are different strategies. QQQI is a NASDAQ 100 high income ETF covered call strategy, which distributes income on a monthly basis. The expense ratio is much higher than SCHD at 0.68%, but its distribution rate, its dividend yield, has been quite attractive at 14% annually. Really attractive stuff as compared to that 3 to 4% that you see from SCHD. So quite different dividend yields there. And of course, they're holding different assets, right? So if we do a fund overlap and we have to look at QQQ, which is what QQQI is holding. But if we look at QQQ and we look at SCHD, there's effectively like a less than 5% overlap between these two ETFs in terms of holdings. And SCHD has much more assets held in energy, staples, healthcare, financials, etc. Whereas QQQI is pretty much all allocated to communications and tech. And so, like right off the jump, you have to have a different philosophy with this. Like, do you want to be in more value companies, or do you want to be closer to tech and more towards high growth but also higher risk assets? All right. Now, the cool thing about QQQI is, traditionally companies like NVIDIA, Microsoft, Apple, Broadcom, Meta, Netflix, they don't really provide yields. They don't provide great dividend yields, but QQQI is able to harvest the volatility against these high volatile companies and high growth companies to harvest income from them. So in a way, it's generating yield from QQQ, from its base assets, which I think is really cool. And you can see the kind of the difference in types of companies, right? As I mentioned before, Chevron, Altria, AbbVie, Merck, Home Depot, Coca-Cola on the left-hand side, that's for SCHD, and for QQQ, it's NVIDIA, Microsoft, Apple, Broadcom, Meta, Netflix, Tesla, much more high growth companies, kind of the best names in terms of tech. So right off the jump, you kind of need to make a decision. Like, do you want to be, planting your flag with some of the more value style companies, which, truly aren't seeing phenomenal growth rates, earnings growth? Or do you want to be planting your flag with some of these higher growth names, which have been strong for decades? Okay, so that's something we have to compare. And then, but of course, we do want to understand that, SCHD is, you're just owning the underlying assets. and allowing those companies to pay you out dividends, and of course they consolidate it and pay you out, in a one lump sum fashion. Whereas a QQQI is certainly a covered call strategy where it's harvesting the volatility, it's issuing covered calls and generating a premium from the options market. So of course there is a bit of an alternative investment style there, but the underlying assets, and they do hold the underlying assets, and that is, of course, the NASDAQ 100 underlying asset. All right, so let's look at its performance. Let's look at its price return. Let's look at SCHD's price return over the past year as compared to QQQI. We're also going to look at the base asset, which is QQQ, and then also JEPQ, which is a longer term NASDAQ 100 covered call strategy, because I want to show you guys like the longer term what SCHD versus JEPQ looks like. So from a price standpoint, we always start with price return. Okay, SCHD over the past year has delivered negative 1.24% over the past year in terms of price return. Whereas QQQI, a covered call strategy, mind you, a covered call strategy has netted a price gain of 6.29%. And of course, the base asset is 22% and JEPQ is at 5%. So, despite the fact that SCHD is holding just the underlying assets, it has done a negative return, whereas QQQ holds the underlying but is issuing covered calls. This has delivered a 6.2% return on just price alone. What I actually want to do is add in GPIC as well for a bit of appreciation, what appreciation can do. So with GPIC also, which is Goldman Sachs' NASDAQ 100, that's the 9% price return. So very interesting stuff how these covered call strategies, which aren't supposed to generate NAV increase, which are always supposed to decline, and you're paying yourself out and you're eroding, well, guess what? They're actually beating SCHD from a price return standpoint. But this is the next piece, the total return, is where the story gets wild. All right, SCHD over the past year has generated 2.47% annual return, okay? QQQI, 22%. QQQ, 23%. JEPQ, 17%. GPIC, 22%. Look at that, guys. Look at the difference there. And yes, it's only been 1 year. And QQQI has only had like a very short amount of time in terms of history, but I'm going to show you GPIC and JEPQ against SCHD, which have a little more runway. But QQQI compared to SCHD, is it a no-brainer? Like look at these total returns, right? So I mean, apples to apples. When we're looking at total returns, and then we can look down here also at dividend payout, dividend yield, right? Dividend yield, SCHD 6%, QQQI 14%. QQQ is not the yielder, right? It's QQQI, which you can generate your yield. JEPQ 11%, GPIC 10% versus SCHD. I mean, come on, guys. And even like a JEPQ, sorry about that. Even a JEPQ shows dividend growth, right? Because the capital appreciation, the NAV appreciation, will net dividend growth. Where do we go here? Where are we? So yeah, so over the past 3 years, I mean, it says 53% dividend growth over the past 3 years, whereas SCHD has only been 8% dividend growth over the past 3 years. Okay, so that's from a 1 year standpoint. Looking at the total returns for 1 year, we see 2.47% versus 22%. Okay, can we go to 3 year and see what happens? Total return for 3 years. Okay. These guys like JEPQ and a QQQ certainly have some history, so that helps. So we can do this analysis. Okay, so SCHD over the past 3 years, total return, guys. Total return includes dividend reinvested and the price return. So 28% since 2022 for SCHD. Compare that to 95% for QQQ and 70% on JEPQ. And even with QQQ's history, QQQI has only been available since 2024, just basically for 1 year and a bit, like a year and a half or something. QQQI is already beating SCHD's 3 year return. Just take that into consideration. QQQI in 1 year has beaten, in 1 year and a half rather, has beaten SCHD in 3 years. So, again, this is a short-term analysis. Like if you expand it out further, SCHD, has shown decent stability. But again, like it's not a problem to invest in SCHD because you're getting a diversified value equation into your portfolios. But it is eye-opening, right? It is eye-opening to take a look at their total returns and say, like, where do I want to plant my flag? Where do I want to invest my 10K, my 20K? Do I want to plant my flag in tech and yield an income there? Or do I want to go with kind of like this, weaker returning SCHD? That's something, we want to consider and evaluate. And for those that are really bullish on SCHD, I would love to know why. Like, what is it about SCHD that really has you excited? I'd love to know, because for me, and again, it's not financial advice, it's for educational purposes only. I want to plant my flag in higher tech, and in things that can generate me a higher income with NAV stability and NAV growth, like a GPIG, like a QQQI, like a QQQ, even the base asset. Whereas like this SHD, which people are preaching, it's shown weak results. So I'd love to know your perspective on this. Guys, are you invested in SCHD? Are you invested in QQQI? Are you invested in JETQ, QQQ? What is your portfolio mix? Let me know in the comments below. Hopefully this was helpful. Hopefully it was eye-opening. What I wanted to do is kind of engage with the SCHD community here and get their feedback. Leave a comment below, guys. All the best and cheers.